What's going on, everyone? Today we need to talk about Ontario real estate because despite near record home prices, brutal affordability, and interest rates that have completely reshaped the market, there's a growing group of economists and housing experts who believe Ontario home prices could face a major correction by 2026. And before you panic, this doesn't mean every market is crashing, and it definitely doesn't mean housing is doomed, but it does mean the market is changing in ways most buyers and sellers are not prepared for. So today, I want to break down why some Ontario markets are already showing cracks, how cycles, inventory, and interest rates play into a 2026 slowdown, which areas are most at risk, and most importantly, what you should actually do about it. Because the worst thing you can do right now is listen to headlines without context. First, we need to talk about seasonality because this trips up almost everyone. Ontario real estate follows a very predictable cycle every single year. Prices and demand typically peak in the spring and early summer when families want to move before school starts, listings look their best, and buyer competition is at its highest. Then what happens? By fall and winter, demand slows, listings sit longer, and sellers quietly reduce prices. Even if the headline still says prices are up year over year, historically, Ontario markets can see 8 to 15% seasonal price swings, and in colder regions like the GTA, Hamilton, Niagara, and Southwest Ontario, that swing can be even larger. So when people say prices are still holding, often what they really mean is they're comparing spring prices to spring prices, not acknowledging what's happening underneath the surface. And once you understand that, the rest of this conversation starts to make a lot more sense. Now, here's where things get interesting. There's a long-standing concept in real estate economics called the 18-year property cycle, originally studied by economist Fred Harrison, and historically it is lined up surprisingly well with major housing booms and correction, including the early 1990s crash in Ontario and in the 2008 downturn. The cycle works like this. A crash or correction resets the market. Roughly 14 years of expansion follow, then 3 to 4 years of slowdown or decline. In Ontario, the last major correction occurred between 2017 and 2018 after the stress test and foreign buyer taxes were introduced. From there, prices rebounded, then exploded during COVID, and now we're in the late stage of that expansion. If this cycle holds loosely, 2025 to 2027 become the danger zone. Not because prices must crash, but because affordability, debt, and supply stop lining up. Now, let's talk about what's actually happening on the ground. Across Ontario, we're seeing rising inventory in suburban and investor-heavy markets, longer days on market, more price reductions, especially on condos and townhouses, and fewer multiple offer situations outside prime areas. Condos are the biggest red flag. Many investors bought pre-construction units assuming prices would keep rising, rent would always cover the mortgage, interest rates would stay low. That math no longer works. We're already seeing investor listings increase in Toronto, Mississauga, Brampton, Vaughan, Hamilton, and Kitchener-Waterloo, especially for small condos and entry-level units. At the same time, new construction completions are adding supply into the market where buyers are stretched thin. That doesn't cause a crash overnight, but it creates downward pressure. Here's the part no one likes to talk about. Ontario hasn't run out of buyers. It's run out of qualified buyers. Between stress test rules, high interest rates, record household debt, rising property taxes, insurance, and utilities, buyers simply can't stretch any further. Even if rates drop slightly, prices don't automatically surge because income hasn't caught up. And once affordability breaks, prices don't rise. They stall, then soften. That's usually how corrections start. So does this mean Ontario housing will crash? Not evenly. Highly desirable, supply-constrained areas with strong end-user demand, think established neighborhoods, good schools, transit access, will likely hold value better. But markets that rely heavily on investors, pre-construction, speculative demand, or endless price growth assumptions, those are the areas at risk. This looks less like 2008 and more like flat prices for years, selective declines, and painful losses for over-leveraged investors. Here's the practical takeaway. If you're buying, only buy if you plan to hold for 10 plus years. Make sure you can afford the home even if price dips. Stop chasing appreciation, focus on lifestyle and cash flow. If you're selling, don't price for 2021. Don't assume demand will come back. The best listings today are priced correctly, not optimistically. And if you're waiting, you're not crazy. Patience may actually be rewarded this cycle. I'd love to know what you think. Do you believe Ontario is heading for a correction by 2026? Or do you think supply shortages shortages will keep prices high no matter what. Drop a comment below, hit the like button if this was helpful, and subscribe for more real, local Ontario real estate insight, not headlines.